All right, let's just jump right in. We are staring down the barrel of 2026, and everywhere you look, asset prices are through the roof. We're talking stocks, housing, gold, silver, you name it, it's at or near a record high. It's a year that is absolutely packed with massive economic shifts, and today we are going to break down the single biggest, most dangerous mistake that will trap most investors, and, more importantly, how you can sidestep it completely.
So, here's how we're going to tackle this. First, we'll set the stage and look at the economic perfect storm that's brewing for 2026. Then, we'll pull back the curtain on the psychological greed trap that this storm creates. After that, we'll get practical and arm you with 3 golden rules to keep you grounded. Then we'll show you exactly why time in the market crushes timing the market, and we'll finish up by looking at the ultimate battle, your emotions versus your logic.
So what is it about 2026 specifically? What's making this year so uniquely volatile and, let's be honest, so uncertain for all of us as investors?
This is the million-dollar question, isn't it? Are prices going to keep rocketing up? Are we headed for a massive crash? Or will things just go sideways? Look, everyone you ask has a theory, but here's the stone-cold truth. Nobody, and I mean nobody, really knows what's going to happen. Not the gurus on TV, not the wizards on Wall Street, nobody.
And this slide right here gets to the absolute heart of it. This is the mistake. The trap isn't guessing the wrong direction. The trap is trying to guess at all. The winning move isn't predicting what happens tomorrow. It's being prepared for the long haul, no matter what tomorrow throws at you.
Just look at all the forces smashing together in 2026. You've got the Fed expected to fire up the money printers again, which tends to pour gasoline on asset prices. We've got huge new economic policies coming down the pike in the US, and of course, ever-present tensions with China creating all sorts of uncertainty. Then, in May, a brand new leader takes over the Federal Reserve, which could totally change the game on monetary policy. And all of it, is happening while the AI revolution is accelerating at a speed that is just breathtaking. Any one of these things could shake the markets. Together, well, it's a recipe for unprecedented volatility.
And all that volatility, all that chaos, it creates the perfect breeding ground for one of the most powerful and dangerous human emotions an investor can feel: pure, simple greed.
I mean, take a look at these numbers from 2025. When people see silver jump 165% in 1 year, their brains start to get rewired. They start thinking that this is normal, that this is what they should expect, and they completely forget that the historical average for the stock market for a century is closer to 10% a year. This creates these wild, unrealistic expectations, and that's when the greed trap snaps shut.
You know, there's a classic saying on Wall Street that just nails this perfectly. It means you can make money if you're optimistic, that's a bull, and you can even make money if you're pessimistic, that's a bear. But the investors who always get wiped out in the end, they're the greedy ones. They're the pigs who chase insane returns and ultimately get slaughtered.
So, the big question is, how do you make sure you don't end up as a pig at the slaughter? Well, it all comes down to sticking to 3 simple, timeless, and frankly, non-negotiable rules of investing.
Okay, rule number 1. Remember that investing is a marathon, not a sprint. We're talking about compounding wealth over decades, not trying to get rich by next Tuesday. Rule 2, and this one is huge: never, ever invest scared money. That's cash you might need for your rent next month or for an emergency. As soon as you do that, you've handed control over to your emotions. And third, please don't just chase the latest hype. Actually understand what you are buying and have a real conviction in its long-term value.
Now, if you need some perspective, just look at this number. Warren Buffett, arguably the greatest investor who ever lived, over his entire legendary career, his average annual return was about 20%. Not 100%, not 200%, 20. And that discipline made him one of the richest people on earth.
So this is the question you really have to ask yourself, right? If the undisputed master of the game built a global empire on patient, disciplined 20% returns, what makes us think chasing a 200% lottery ticket is investing? Let's just call it what it is. That's gambling.
Okay, so let's see how this long-term, disciplined mindset actually works in the real world. Because it really all boils down to one incredibly powerful, yet simple concept.
And the difference here is absolutely critical. Time in the market means you stay invested for the long run. You ride out the highs and the lows to capture that overall growth. Timing the market? Well, that's the fool's errand of trying to perfectly jump in at the bottom and jump out at the top. One is a proven strategy, the other is basically a recipe for anxiety and most of the time, failure.
Let me tell you a quick story. Imagine the world's unluckiest investor. I mean, this person's timing is just comically bad. They put a chunk of money into the market at the absolute peak of the dot-com bubble in 2000.
Then they did it again, right before the 2008 financial crisis. And again, right before the COVID crash in 2020. And for good measure, they bought again in 2022, just before the market tanked 20%. You literally could not have picked worse moments to invest.
And yet, and here's the punchline, if that investor just held on, if they never panicked and never sold, they would still be significantly richer today than the person who stood on the sidelines, too scared to invest at all. That is the incredible power of time in the market. It's so powerful it can even forgive the worst possible time.
And that brings us right to the final showdown, the battle that every single investor faces, especially in a wild year like 2026. It is the constant, relentless tug-of-war between your emotions and your logic.
This table just lays it all out. The market crashes, what does your emotional brain do? It screams, get out, it's all over, sell everything. But your logical brain? It calmly says, it looks like some great companies just went on sale. When the market hits new highs, the emotional reaction is greed. I gotta chase this, I have to sell at the very, very top. But logic just says, stay the course, stick to the plan, trust the process.
So, as we wrap this up, let's boil it all down to your key takeaways for navigating 2026. Number 1, your job is not to be a fortune teller, it's to be prepared. 2, market ups and downs are not just possible, they are inevitable. Learn to see them as opportunities, not just threats. And finally, remember that a disciplined framework built on simple rules will always outperform emotional, panicked reactions in the long run. And so I'll leave you with this one final thought. The markets are going to move. They're going to go up and they're going to go down. That is the only guarantee. The only real question you need to answer is, when they do, who's going to be in control? You or your emotions?